Welcome back to another weekly episode, guys. So today I'll be talking about the stocks that I had shortlisted for the last cycle, and I had shortlisted about 40 stocks that I had shared with you guys also. Of course, with a lag of a couple of weeks, I had shared this, and within this 40 stocks, I had also not disclosed which stocks I went behind, and obviously I cannot do it. Similarly, in the current cycle, last week's video and the one before that, I shared my 40, 50, 60 stocks that I've initially shortlisted for this particular cycle. And the newer list, obviously, I'll discuss in the next quarter so that there is no violation with respect to SEBI. So I would like to clarify one thing, that all trades in this are over. There is no risk reward here, and you cannot initiate fresh positions here. But what I'm going to do in the next 4 episodes, is that I'll divide this list, because this is a total of 40 stocks. I'll divide this list into 10 stocks in each episode, and I'll show you why I shortlisted, what one should have done or what one can do in case somebody is holding some of these stocks, basically how to go about it. I'll also link up few things with short-term cycles, medium-term cycles, and those kind of things. So out of those 40 stocks, what I've done is the first 10 stocks, I've just put out the list in the expanded form here, so that if it is very small on a mobile device, it can be clearly seen here. All right. So today I'll be covering Aditya Birla Capital, ACE, Anant Raj, Anupam Rasayan, Apar Industries, Data Patterns, Deep Industries, Ganesh Benzo, GSPL, and HAL. Now, in these 10 stocks, the top performing stocks were ACE, Anant Raj, Apar Industries, that are one bagger as of now, that is 100% plus. 50% plus were Deep Industries, HAL, all right. And something that underperformed Nifty and did not do well with GSPL and Ganesh Benzo. And Aditya Birla Cap and Anupam Rasayan have still managed to outperform Nifty. So the thing you got to see in these first 40 stocks is you will hardly find any stock that has underperformed Nifty, and most of the stocks are in higher double-digit returns. The similar thing, ultimately, when we discussed in the next quarter, the current list that I've shared, you'll see a similar kind of performance given stability in the global market and our market. If our market starts to correct a lot, obviously nothing works out. In which scenario, everybody has to focus on capital preservation and cutting out losses. How these stocks are being picked out, there's nothing magical about it. There's no app behind it. There's no secret behind it. In fact, these were the first 40 stocks that were breaking out when the index was struggling. Again, the last week's list that I shared in the last week's video and the one before that, those are nothing but the first 40, 50, 60 stocks that are breaking out. So there is no proprietary kind of a thing here, no secret here, and those kind of things. Yes, of course, there were still many other stocks that were breaking out. So there was some reason I went behind only those 40, 50 stocks that I shared, the complete list. That is my watch list. I can do that much at least, but I cannot disclose which stocks out of those stocks I've picked out, or I cannot even disclose which stocks out of these I hold. All right. So I hope that part is clear. So that particular skill about picking out stocks from a list of stocks or a basket of 2,500 stocks that are there on NSE, it takes time to come. I won't lie about it. It's ultimately about analysis of trend. This is a slide I've shared many times when I've made videos. Sticking to daily time frame and weekly time frame, combination of that, I don't think anything less than this is required. And using simple candlestick and volume analysis, what I look for, I like normal price behavior. When the price is expanding, volume should expand. When the price moves lower, volume should contract. That is, volume should go lower. And one key thing that I've not written here or missed out here is that I look for relative strength, not RSI, relative strength, comparative relative strength, which means the stock against Nifty 500 or Nifty 50 has to be in a outperforming kind of cycle. So this is a critical component. The next critical component behind my method of shortlisting stocks is taking less stress, which means getting rid of most short-term data points, no FNO, no nothing, no option chain, nothing about news, politics, social media, WhatsApp, opinions. So for those of you who follow me closely, you will see I barely post anything on social media. If I do, it will generally be about some market chart or the video update or about cricket. Apart from that, you'll never see me interacting with anybody, not replying to anything. Nothing of that religion, news, politics, all those kind of things I completely stay away, because that has nothing to do with day-to-day life. All right. The third critical part is treating every correction as an opportunity. Now, every correction in the market is not a crash. Why I again have to repeat this? Because the moment markets fall 10 odd percent, you start seeing videos both in the US and in India that 50% is going to go, Michael Berry is going to go short, so and so investor is short, and those kind of things. So I have always advocated that use corrections as an opportunity to at least build a watch list. At least going behind those stocks that are breaking out. At least put it in a watch list. Nobody's asking you to do anything. So those are 3 stages that I had explained two weeks back. That is, the first stage is building a watch list. The second stage is deciding what kind of position sizing method you're going to use, and the third phase is eventually going behind that structure. So what I advocate is, whenever the short term gets dicey in the market, like it was a couple of months down the line, you always have to adjust your position size. Nobody's asking you to go 100% all in. Buy 10% position, see what happens, and then gradually decide what needs to be done. All right. So the first structure I'll highlight is Aditya Birla Capital. Now this is something that gave a long-term kind of contraction was going on here. Again, most of the charts that you'll see that I'll post are not similar to what Mark Minervini posts about VCP. His patterns are very different. At times you will see I'll be going behind very different kind of VCP patterns, because textbook patterns you don't get in the market. You have to pick out patterns that look similar, and underlying psychology behind that pattern that should be playing out. So Aditya Birla Capital I had shortlisted at 151. So if, let's say, I had picked up this particular stock, initially when you pick up the stock, your stop loss just from position sizing point of view has to be this. When stock starts moving in your favor, that is when you quickly move up your trailing stop loss and increase your position size. So if I were someone who will be holding this stock, I'd actually do nothing. From a trend perspective, if you go one higher time frame, you'll see this is where the structure was valid. Even now, this is the trending pivot. This is just another trending pivot. And over a period of time, of course, after confirmation, because anything can happen, after a wide range candle gets printed, you'll see that the trend will continue. So I don't know if I can draw something out here. Let me just try. So if I were to mark something out, this is nothing but a flag kind of structure forming. Can you see? So, it can easily do this and continue moving higher. So if someone was holding Aditya Birla Capital from the last cycle and believes in this company and does not want to go in and out, doesn't want to switch positions a lot, then nothing has changed structure wise. This is a trending pivot. This is a trending pivot. Right now price is forming one more trending pivot. All right. So let's move on to the next stock. That is Action Construction Equipment. So this was a beautiful contraction that played out. So this was the point where this stock came into a proper structure. That is a actionable structure. Again, if you mark out the long-term trending pivots, and now it is forming one more pivot. So if you note what happens once you select a stock, we generally have a tendency to look out for a newer opportunity or some new breakout, some new scan is coming out, but generally stocks will keep forming bases and keep moving up. What do you think is happening here? This is one more base in Action Construction Equipment. Why can't you buy here? You can't buy here because risk reward goes out of the window. That is where you gotta catch stock when it is coming out of its first base, as opposed to catching a stock here when it is already 120, 130% up. The next stock is Anant Raj. Again, look at the similar charts, the similar structure I post. All right, again, this was where the pattern got valid. And this has been an exceptional stock. It's been an exceptional stock. First, I'll mark out all the trending pivots. So this pivot and this pivot here are major pivots. These are minor pivots. If you don't understand how to do this, then you've got to go back in my library and check it out, because these are some basic things I've repeated many times, and especially those who follow my videos every week would understand why this is a major pivot, why this particular pivot is a minor pivot. So as of now, maybe some quarters down the line, Anant Raj will do something like this and again move up. So this will be one more major pivot on the chart. But if I were someone who bought it today, I would do nothing but keep trailing positions till the point this is my current trailing loss. 220 is not violated. Let broader market corrections happen, but you can just simply keep trailing positions. Anupam Rasayan, when I shortlisted this stock, was the first stock that vertically moved up. And I was very optimistic about this stock. But then in June, July, I started seeing this mini kind of stage structure. I still have the marking on the chart. And this was then a clear lower high, lower low structure. What do I typically do in such phases? I cut out 50% positions and wait to see what happens. In case of Anupam Rasayan, obviously the stock kept on moving lower. This was one more lower high, lower low. And this is where you completely exit positions, because this is a second lower high, lower low violation that happens. So this stock is, and let's say I was interested in this stock. Let's say I held it. Let's say I exited it. Will I be interested now in this particular counter? I would say no, because look at the wide range candles that have got printed as prices moved lower. And look at this candle also. So I can just spot one bullish candle here. After that, all these candles are narrow range candles. So I'm not interested in such structures. Apar Industries was another stock. It was similar to Rasayan. Can you see a flag kind of structure? Look at Apar. It was again a flag kind of structure, but it was actually a stock that came on my radar in 2022 cycle. For those of you who were here in 2022 June, Apar was one of the stocks that, along with the I think Masgaon and those kind of stocks I had identified, which were breaking out before the market. So Apar came in from the previous list. But again, what it did here, a vertical movement. I think some result announcement had come and stock had a vertical fall, and then it bounced back. And then a confirmation out here again. And what has the stock done since then? Major pivot. This is one more major pivot. And look at the time it forms basis. Instead of seeing things like OI or some indicator or those kind of things, you have to see how stocks just form bases and keep moving higher, or stocks will keep forming bases and keep moving lower. Ultimately, this is nothing but stage analysis that Stan Weinstein teaches in his book. The next stock is data patterns. Again, look at the similar structure that I've shortlisted. This was a valid pattern. If I were someone who traded this stock, then I held on this stock till the point this particular pivot was not violated. So it went up, it came down, you do nothing because corrective price action develops, but something changed here and the stock, can you see here, went below this particular pivot level. So the trade was still okay. If someone bought it at 1400, from 1400 to something like 2000, it was still okay kind of a trade. Not bad. Clearly outperformed Nifty. The next stock is Deep Industries, and this particular stock, if you see again, look at the similar structure that I go behind. Look at the breakout candles. I haven't put the volume out here because it just clutters the screen, but volume was something like this. Go and check the chart. So the stock consolidates, gives another wide range candle. If I were someone who bought the stock here, then this is one major pivot, this is one minor pivot, this is one major pivot. The violation has not happened, so the stock should have been still held. If I hold the stock and the stock does this 240, that is violation of a major pivot, you simply get out and the trade would still be a good one. Suppose you scaled in at this particular candle, that is initial position here, next position 10% higher, because in that cycle this is what I was doing. It is still a trade with 185 average and 240 exit, which is still kind of fine. Now the two stocks that did not work out were Ganesh Benzoplast and GSPL, within the first 10 names that we are discussing. I thought this structure was very good in March, April when I had shortlisted this, because there was vertical movement in this region. I was seeing volumes were relatively lower, which just tells you that further accumulation is happening. I saw this wide range candle printing on the chart and I definitely thought this was a valid kind of entry. But what happened was, stock just kept moving lower and it came down and violated this particular pivot. So I did not exit this stock. Technically I should have. I did not exit because rest of the portfolio was moving up. So I just wanted to give it more time. But eventually, had I held this stock, then yes, that money should have been put to but better use. And if newer structures were available, then a partial exit or a complete exit from such structures could have been done. And the money could have been allocated to names that are, performing as of that period. GSPL was another structure I felt was doing really well. A nice bit of rounding kind of contraction. Series of wide range candles with tails was forming here. I definitely thought that this stock would do well, especially this candle that you see. This candle actually went up to 312. The volumes were huge, but by the time the closing happened, I distinctively remember I thought this is a structure that won't work out, because this is a huge WRC, that is a wide range candle but with a long wick, and then the stock just did not do well. I still, had I bought it and had I held it, I would have still held it out, because again, rest of the portfolio would have been doing well. But yes, if a newer opportunity would come by, then GSPL and something like Ganesh Benzoplast would be the first names where you sort of trim out positions and completely, go behind newer structures. The last structure was Hindustan Aeronautical, that is HAL. And after I complete this structure, I'll take you to a very important rule that was there from William O'Neill. So just stay tuned. Again, HAL was one stock along with Mazgaon Dock that I had identified in the June-July 2022 cycle, for those of you who are regular. Then I saw one more rounding kind of a base forming. This was also forming in, I think, Mazgaon, Cochin Shipyard. I don't remember if Garden Reach did the same, but there was a lot of group movement, sister stock movement happening. And this was a valid sort of entry. You had a shakeout a couple of days later, but this is a major pivot, minor pivot. Now stock has formed something like a major pivot. So again, if I had bought here and if I was riding this entire trend in the October cycle when Nifty was breaking down, would have I exited 50% here? Yes, I would have. I would have definitely exited 50% positions here. And I think when I would have seen this, I would have built back the remaining 50% also. But some adjustments I definitely make depending on what broader market is doing. If broader market is doing this, I actively participate in booking out profits and reducing position size in newer positions. Let's say index is doing this and some stock is doing this. I'll just buy some pilot positions here and sit just to see what is going on in that particular stock. And when index finally gets back or tries to get back in this particular structure, that is when I quickly scale in, or I decide whether I have to do a systematic trading plan, whether of 8 weeks, 12 weeks, 16 weeks, or whether I have to do a pyramiding. Sometimes I also divide based on the category of stocks. If it is small, mid, micro cap stocks, I'll do a STP. If it's a large cap stock, I'll do a one-time scale in or a pyramid. It all depends upon how a trader feels at that particular point. But yes, nothing wrong with the trend. And if you switch this to a weekly time frame chart, you'll just see HAL is doing nothing but just forming a higher high, higher low structure and just moving up. So now I will I'll bring you to one of the key rules of William O'Neill. It is also linked to a mindset of a trader. So this particular part that I have underlined, I have actually magnified it here so that it is clearly visible on the mobile device, and I'll just read it out for you and I'll explain a few things. So the title is, what if a stock falls back to its buy point? Is it normal? It may be normal. This is written by Dominic Gessel or Gessel, I don't know how to pronounce it. And this is from the Investor Business Daily newspaper that I read on a daily basis. A pullback to the buy point is a normal, a bit frustrating part of investing in growth stocks. Your stocks break out, but before long, it's back or just below the buy point. So I'll just remove this particular marking here. So HAL, when the buy price was here, you draw a line here. The stock not only retraced back to the buy point, it also went below it, not violating the trending pivot though. So this happens. Now, do you cut your losses here before it drops further? Do you hold and wait for it to rebound? What do you do? So typically what I do is, if I buy something here and if I see, let's say this is a 3% drop and this is a 5% drop, typically what I'll do is I'll cut out 33% positions here, another 33 here. But if I again see the stock moving above here, then I quickly build back the positions that I've cut back. So basically you got to be very quick in cutting your positions. This 33% rule is of Jim Roppel, that is cut your positions at -3%, -5%, -7% from your average buy price. Some traders like it, some don't. So knowing the difference between a pause and an impending collapse can feel more like an art than a science. Roughly 40% of successful stocks go back around their buy point before resuming their advance. So be ready for the situation. Now, why this is important? This is important because most of the investors and traders are using scanners, apps to find out stocks that are breaking out today. Which means if they see this happening to their stock, they won't have the patience to hold on to a stock. They will cut out their positions, and then eventually the stock after a few days moves up. Now, let me issue a clarification here. If I see that a stock falls 3% from my average buy price and 5% on really less volumes, then I don't cut my positions out. Then I ride it out. But if I see a case in point, recently, I had picked up one bank that fell 3% against me, 5% against me, and then eventually 7% against me. I cut out all the positions because I was seeing volumes were going up. If the price is coming back, to its buy point, and let's say this was a buy candle volume, and while coming back, this is the kind of volume that is happening, that is volume is contracting, then I won't cut out my positions. So it depends. It is subjective. Every time you cannot do it. Your typical normal pullback will usually occur within days rather than weeks of the initial breakout. You should see a gradual price decline with weaker volume as the stock returns to or just below the buy point. That is buy point. If you see a harsher decline that falls outside of these parameters, what are these parameters? The decline has to be smooth. It has to be gradual. But if the decline happens on back of wide range candle, big volumes, then you have to cut it out. And you should start to consider cutting your positions only if the decline is on back of heavy volumes and wide range candles on the downside. All right. You must familiarize yourself with the IBD sell rules. If a stock has risen 10% from the buy point, you should sell it before all profits are gone. You never want to let a double-digit gain turn into a loss. A 7% dip below the buy triggers automatic sell rule. Now, this is a rule that I don't follow of William O'Neill. I actually follow the Jim Roppel's rule. If the volume is heavy on the downside, that is, I cut 33% at -3, another 33% at -5, and the remaining at -7. So net you take a 5% loss, whereas William O'Neill used to take a 7% loss, on his portfolio. In a rough market, you may tighten that risk to 3 to 4%. But if you didn't chase the stock and bought it extended, it is unlikely this rule will come into play. In How to Make Money in Stocks, which is the book by William O'Neill, the IBD founder William O'Neill wrote, "Buying precisely right solves most of your selling problems." Now, why this is important? Because the list that I shared here, the first 40 stocks that I shortlisted, these were not the only 40 stocks that were breaking out. These were the stocks that I shortlisted out of the 100 odd stocks that were breaking out. If you do the work here properly, you will not have to worry about stocks prematurely hitting your stop losses or moving against you initially. But this homework is important. This homework is important because when the markets are falling, you have to prepare your watch list. And the same thing I've done in this particular cycle. Whatever list I've prepared, that list won't see much of fluctuation unless the broader market and the US market again starts to see not a correction, but a sustained correction kind of a move. So there is a difference. That is why your watch list is also one of your biggest indicators in the initial market cycle phase to tell you whether this is a normal move or a sustained correction that can come in the market. And let me tell you that between October, November, when I was making a list, it is not that I have bought a lot. It is not that I have bought at whatever bottom Nifty made. That is not true at all. In fact, I spread out my money in stocks that I like. I like to allocate some bit on a weekly basis. Some stocks I go behind in a one bit, but those things are different. So it is not that the recent bottom that Nifty made, I have made a lot of allocation then. No, but I was doing a lot of homework. I was shortlisting stock for the next cycle because that is a process. Ultimately, you have to understand that Investor Business Daily, that is William O'Neill rules that he has given out in the market. These are not the only rules that work in the market. There are rules by Stan Weinstein, there are rules by Mark Minervini, there are rules by then William O'Neill, then Richard Wyckoff, all these legends in the stock market who have been kind enough to share their knowledge. Their rules are not the only rules that work. So ultimately, you have to take the teachings of all these people and form your own framework, form your own buying and selling criteria, which comes largely by trial and error. And that is where most of the traders and investors lose out, because who has the patience to see equity rising 20% in 7-8 months, where you can sell straddles or strangles or options and potentially write that you're making return on investment of 10% on every trade. So and without even considering the huge taxation that is there in short-term trading and in F&O. So you have to realize that there is always a balance between what is right and the path that you have to take in the market. This particular path that I show is derived from the teachings of all these legends in the market, and somehow this works for me. It's not necessary that it will work for a lot of people who don't have the commitment to go through charts on a weekly basis, do homework, because we come from a sort of a school culture where I don't think majority of children like doing homework, including me. So it was a habit that had to be built. Doing homework in stock market is 80% of the money. 20% is just something that you realize over time. But unless you do homework, unless you go through 500, 800 charts in a week, which is not difficult, because if you check your timer on the phone, you spend far more time on a Twitter, that is X, or a Facebook or Instagram, or reading meaningless things on social media. So it roughly takes about a couple of hours on weekend to go through 500, 800 stocks, or the top 1,000 stocks, and note down which stocks are breaking out, what is the broader market doing, what do you feel is important in terms of position sizing. Do you have to go all in? Do you have to spread your money out over 8, 16 or 12 weeks? Or can you deploy something like a pyramiding strategy? A pyramiding is nothing but, if a stock is, you initially buy some 20% here, then another ad when a fresh breakouts happen here, then again a breakout here, then again a breakout here. So you just gradually keep increasing positions, which is nothing but pyramiding or taking progressive exposure in the market. So in this particular episode, I have covered the first 10 names. I sorted it based on alphabetical order. So in the next video, I'll cover KEI, Kirloskar Electric, Oil, KNR Construction, and some of these stocks. That is from 11 to 21. I'll be covering in next episode, along with some of the insights that I can give you about the structures and what rules to follow. So have a great weekend ahead, guys. Take care, be safe. In case you've missed the last 2 episodes, go through it. That is where I've shared the list for the current quarter. And there is some difference there, because I'm not going behind 20 or 40 stocks from that list, only about 8 to 10 stocks. Obviously, I cannot disclose that, but a watch list is something that I can definitely disclose, because those are just stocks that are breaking out before index. So there is no kind of a secret or a proprietary or anything of that kind. So have a great weekend. Take care and be safe.